Welcome to Veranda CA. Welcome to Veranda CA. In today's session, we are going to discuss about tax planning, avoidance and evasion. Basically, in the previous session, when we are just talking about the importance of subject, the weightage that is given, we said there are around 10 to 15% in both these chapters, that is trust and tax planning, avoidance and evasion. So, both these chapters, both the trust and tax planning, avoidance and evasion has importance of around 10 to 15% in your examination. So, what is this? Basically, when you are talking about this, there are means in which you can reduce taxes, right? So, you can prefer certain methodologies to reduce taxes. So, when you say reducing taxes, there are three possible scenarios for any man. So, basically the first one is planning, that is tax planning. So, when you say tax planning, what is it? We'll probably take an employee, right? An employee who is receiving salary. In the month in which he is receiving salary, generally an employer requests, give me your tax declarations. What all investments you have made during this particular year. So, to reduce his taxes, the employee says, I have invested in insurance, I have invested in, let's say, PPF, I have invested in national pension scheme. So, all these things, I have an house property, so I have a loan from house property, that is for which you are eligible for deductions. So, which means your taxes will get reduced because of these factors, because of these insurance, because of PPF. So, probably let's say you have 1.5 in ATC and 50,000 in NPS, and then you have this house property loan where probably another 2 lakhs exemption deductions that you get. So, all these are what is called as planning. So, this is perfectly fine, right? So, basically it is okay you reducing taxes and getting benefited out of it. So, these are tax benefits that are due to the assessee, which is perfectly fine. The next one is called avoidance. So, what do you mean by avoidance? Here again you know the provisions, okay, you know the law. So, you know the law, but with an intention to avoid, that is there is an intention to avoid. So, you are actually not planning. With the intention to avoid taxes, you take a methodology whereby you avoid taxes, let's say by not reporting, or you are trying to misuse the provisions or whatever. So, you are actually avoiding taxes, you are not trying to properly plan the taxes. So, whatever you are actually eligible for tax benefit, you are utilizing the law, but in an inappropriate manner, with the intention to avoid taxes. So, there is some clear intention of avoiding taxes. And when you say this planning and avoidance, or probably it's a thin line, okay. So, what is planning, what is avoidance is more or less the same, only the intention varies. The intention to avoid taxes, your intention is not to plan, your intention is not to claim tax benefit, your intention to avoid taxes. So, how do you actually prove that? It's pretty difficult, but yes, there are certain provisions which will help you understand the intention of the transactions. The third one is evasion. When you say evasion, you are basically using deceitful practice, that is you are using strategies, strategically you are planning in such a way that you evade taxes. So, this is probably like something like what it could include your illegal form of income, fraud or whatever thing. So, these are categorized as tax evasion. So, these three are the possible ways in which taxes could be reduced, and of course, I do not tell you what is right, what is wrong. So, basically tax planning is perfectly fine, you are allowed to save taxes in the manner that is possible, that is in accordance with the law. But avoidance and evasion is typically not the approach. Both these are not the let's say tax authorities objectives are. So, their objective is not to see that you avoid taxes or you evade taxes. So, that is important. So, what should be done? So, there must be practices or procedures or probably provisions which are in place to see that there is no tax avoidance, there is no tax evasion. Let us take for example, we discussed about transfer pricing, right? Or there are provisions like 40A2B, whereby it is relating to related party transactions. So, where you transact with the related party, you just shift the profits, knowing that he is a related party, you pay them more, you pay them abnormal, like, so the purchase, the cost of expenditure is higher as you are paying to the related party, so that you are booking more expenditure, which means reduced profit. So, through related party transactions, your expense is higher, so that your taxable profits are lower. So, this is the intention of 40A2B. We also discussed about your specific anti-avoidance rule, that is called as SAR, specific anti-avoidance rule. It is typically your TP, which includes specified domestic transactions. So, all these are specifically, it is structured, these provisions are structured in such a way that transactions must be entered at what? We have discussed in detail. So, generally any transfer pricing transactions or including the specified domestic transaction must have been entered at what price? At arm's length price. So, only then it is legitimate. So, to see that taxes are not avoided, to see that taxes are not evaded, what the government intends to is by introducing these provisions. You have 40A2B, you have 80AR, then you have in section 80A also you discuss about arm's length price, connected person. So, all this are discussed in your 80A also. So, whenever there is a tax holiday benefit given, it is seen that the any transactions between a tax holiday unit and non-tax holiday unit of the same person, it is to be concluded that such transactions are entered at arm's length price. So, these are very important as far as your tax planning is concerned. So, when you say tax planning, it is perfectly fine. To see that taxes are not avoided or not evaded, government has introduced various provisions, something like what we saw now, 40A2B, your SAR, that is specific anti-avoidance, and 80A. Now, apart from these, we said there is something called specific anti-avoidance rule, right? So, we said there is something called SAR, which typically covers your transfer pricing, including your specified domestic transactions. So, these things, it also includes your DTA and other things, right? So, there are also clauses in DTA to see that the tax benefit is actually transferred to the respective person. This SAR is actually discussed in chapter 10 of the Act. So, this chapter 10 of the Act provides various provisions whereby it sees that taxes are not avoided or evaded. So, chapter 10 discusses about TP provisions, which is called as SAR. But these are all specific, right? What if there is some arrangement, some agreement or some transaction where the intention of the transaction is avoidance of taxation? How do you control this? So, to actually take this into consideration, we all probably vaguely remember that there was something called Direct Tax Code, which was proposed to replace the Income Tax Act. So, the Direct Tax Code was proposed to replace the Income Tax Act. So, this was proposed in 2009. There was a draft version also. It went through various draft versions. So, in this Direct Tax Code, something called GAAR was proposed. When I said SAR, it is specific anti-avoidance rule. So, what is GAAR? So, everything else remains same. G stands for general. So, it becomes general anti-avoidance rule. So, when you say GAAR, it is general anti-avoidance rule. So, that is your GAAR. Okay. So, now GAAR was introduced, was proposed to be introduced in the Direct Tax Code in the 2009, and there was various discussions, including a discussion paper in the year 2010. All those are history. But as we all know, Direct Tax Code was never implemented, It started with the draft stage, it ended with the draft stage. So, in this particular draft Direct Tax Code, certain attributes, certain characteristics or certain features or certain provisions were taken into the Income Tax Act, were considered part of the Income Tax Act also. So, one of them was GAAR. So, GAAR was supposed to be made applicable from 1st April 2012, but it was not introduced because, as we all know, Direct Tax Code itself was deferred. So, till the Union Budget 2012-13 said, let's not wait till Direct Tax Code, let's not wait till whether it happens or not, it is irrelevant, let's introduce certain provisions. So, one of them was this GAAR, that is General Anti-Avoidance Rule. This was introduced through Union Budget 2012-13. So, what did the Union Budget 2012-13? See, there are interesting case laws like Vodafone and certain transactions where certain cases where there was complete decide, that is the intention of structuring the agreement, the arrangement itself was to avoid taxes, to evade taxes. So that was the intention behind, though it is completely legal, though it is within the framework of law. So please understand, it is completely legal, it is completely within the framework of what the Income Tax Act proposes, but still taxes are evaded. So it is very well clearly planned activity to see that taxes are evaded. So such activities made the government think through and say, let's not wait till direct tax cut, so let's propose it right away. So it was proposed to create a general anti-avoidance tool as a tax avoidance scheme. So now when you speak about GAAR, okay, when you speak about GAAR, we'll first understand it is covered under Chapter 10A of Income Tax Act. So Chapter 10A of Income Tax Act. What did we say for 10? It is SAR, that is specific anti-avoidance, that is TP provisions. So 10A is for general anti-avoidance rule. So there is no confusion in remembering these chapter numbers. So it is Chapter 10 for SAR, Chapter 10A for GAAR. So the section from 95 discusses about what are all about GAAR. In that we have always spoken about an important requirement of the law is to have clear definitions, So we have section 2 for the whole of Income Tax Act. Here and there we have separate sections for definitions. So we have, let's say, we have 43 for business or profession, right? We have 92F for transfer pricing. So all these are definition sections. Similarly, the definition section, that is the definition section in the Chapter 10A is 102. So that is 102, section 102 provides definition for various terms used for this chapter alone, So we will see some of them before we actually step into the concept of GAAR, what exactly it is. So the first one that we are going to see about is a word, an arrangement. Okay. Now when you speak about this word arrangement, what exactly do you think the word arrangement refers to? In regular language, in a common language, in English language, what does the word arrangement refers to? Something, let's say some planning, right? You have something to do with the other person. Whatever has to be done, you have discussed through, let's say, verbally or orally, in some form or other, you have a structure in which this arrangement will happen, that is, and particular engagement will happen. So basically it is to say, I will transact with you on so and so manner. That's what an arrangement means, right, in general word. So it's basically typically what the common words is, some form of agreement between two people or two or more people. So what does section 102 says? 102 says it is any step in, it could be a part or a whole for a particular transaction. So it could be, the step could be relating to a transaction, could be relating to operation, could be relating to a scheme, could be relating to an agreement, or even just an understanding, So all this, okay. So any part of a transaction, a operation, a scheme, an agreement, or even an understanding is called as an arrangement. Just they go a little deeper, they say whether it is enforceable or not, which means whether that is legally valid or not, whether you could go on dispute on legal grounds or not. So it doesn't matter. It doesn't matter whether it is enforceable or not, and it includes alienation of any property in such transaction, operation, scheme, agreement, or understanding. So when you say alienation, you are probably taking it away. You are taking it away and keeping it separately. So when there is particular transaction or operation or a scheme or even an understanding in this particular thing, even if it is includes about alienation of any property, that is, even if that arrangement is relating to this concept of alienation of property, it will still be an arrangement. So how do we remember this definition? So probably let's put it across, anything and everything can be an arrangement. So because it says it could be a part of transaction or the whole transaction, operation, scheme, agreement, understanding. So almost like everything, right? And it also goes on to add, It could be enforceable or not enforceable also, it does not matter. So, this is what an arrangement means. So, probably anything and everything between two or more persons relating to a transaction, operation, scheme, an agreement or an understanding will be called as an arrangement. So, this is one of the key definition. The next one, GAAR says it values the tax benefit. So, basically what do you mean, what is the intention of the provision? It says undue tax benefit should not be transferred to one person. Whatever benefit is being attained, tax benefit attained by a particular assessee should be properly in accordance with the law, and the intention should be just a planning and should not be in the concept of avoidance or evasion, right. So, undue tax benefit should not be attained to any person. So, what is exactly a tax benefit? So, they say what is tax benefit is, due to this there is a reduction or avoidance or deferral of tax. Because of what? So, through the act, because of some transaction, the total tax is reduced or is avoided or is deferred. So, if either of this is happening, then it is called a tax benefit to that particular person. Similarly, it could also result in any increase in what? In refund of tax. In the first clause A, we were talking about payments. Whenever there is a tax payment, the tax payment could be reduced or avoided or deferred. But in the second case, we are talking about the refund. We are saying any increase in refund of tax or other amount under the act. And it also includes anything related to the DTA also, that is whatever relating to DTA also can be covered here. And finally, there will also be a situation which results in loss, right. So, when you say loss, you are not going to talk about reduction, avoidance of taxes. You are also not going to talk about increase in refund of taxes. You are not going to talk about these. So, what happens in reduction? There is what happens in losses? There is a reduction in total income or an increase in loss. So, forget tax. You need not have to pay tax. There need not be a refund. Even if there is no payable, even if there is no refund of taxes, it could still be classified as a tax benefit if some particular arrangement is resulting in reduction in total income or increase in loss. So, this very clearly puts across and says that this results in tax benefit to the concerned party. So, this is what you are actually calling as tax benefit. So, it could be relating to any particular year. The tax benefit includes these three concepts. What else? So, what else are the definition that we need to understand? The next definition that we are going to understand is connected person. We are not going to go into detail of this particular definition. It basically, you can just remember in short that whatever person has been covered under section 40A2B, what did we say 40A2B is about? It is about related party transaction, right. So, any payments, any excessive payments made to a related party specified under section 40A2B shall be disallowed in the computation. Now, this payment, whatever we are talking about, is not what we are discussing here. What we are discussing here, the persons listed. So, basically, let us say an individual owning a substantial interest in a particular organization, a director, partner or a trustee of a particular company, firm, all these persons, right. So, directly or indirectly holding shares in another company. So, all these holdings that we are talking about, the substantial interest, relatives, all these concepts which is discussed in 40A2B or what we are calling as connected person, but for this clause called 4 of 40A2B. So, what is this subclause 4 in 40A2B? It is nothing but it talks about two common entities which is being held by a common person, that is one person holding substantial interest in two independent organizations. This alone is not covered in connected person, but still for that is theoretical purpose, but for practical purpose let us understand connected person is nothing but whatever has been discussed in 40A2B, but for this subclause 4 which talks about one entity having substantial interest in two different entities. So, that is only exclusion there. Apart from that, everything is connected and everything is discussed in connected persons. So, all these are discussed in section 102. So, that is the definition section. One more thing that is important definition is commercial substance. So, what do you mean by commercial substance? So, basically any arrangement, we said it could be a transaction, it could be a scheme, it could be an agreement, it could even be an understanding, right? We did say that. Now, in this arrangement, whatever we are talking, when you see the word business, whatever arrangement we are talking is for what? Is for business, right? Whenever it is for business, what is the key element that should exist there in that particular arrangement? What should exist in this agreement is typically called as commercial value, right? Because what you are actually entering is a commercial arrangement. So, it is for the purpose of trade, it is for the purpose of business. So, there must be a commercial arrangement. So, we need to understand what do you actually mean by this commercial value. So, that is defined here as commercial substance. So, the GAAR gets attracted when there is lack of commercial substance. So, which means when the arrangement does not have a commercial substance. So, it is like namesake arrangements for some other intentions. What are that some other intention? It is evasion of taxes. So, how do you control this, right? So, we need to understand this. To understand this type of arrangements, we need to know whether a particular arrangement lacks commercial substances. When does a particular arrangement lacks commercial substances? At the first thing they say, arrangement as a whole is inconsistent with or differs significantly from other part of the arrangement. Let us say there are 10 clauses in an arrangement. Right? In that 8 speaks about some value, and 2 speaks about something contrary or something not in relationship with what 8 is being discussing. It could be inconsistent, or it could differ significantly, from a part of the arrangement. So, that is what in our example we are saying there are 10 clauses in a particular arrangement. In that 10 clauses, 8 speaks a language, 2 speaks a different language. It is contrary, it significantly differs from what 8 wants to achieve. This could also be called as lack of commercial substance. The next one is no significant effect. So, what do you mean by no significant effect? So, when you mean by no significant effect, what you are saying is upon either the business risk or the net cash flows of the party other than effect attributable to tax benefit. So, the intention of arrangement itself is only to give you tax benefit. So, apart from what is being discussed as tax benefit, there is no other significant effect. So, there is nothing else that gets affected. If there is an arrangement, let us say there is a sales arrangement, right, there will be certain risk involved in that particular agreement. Both the parties will be undertaking certain risk. It will financially impact both the parties. Now, what if this arrangement is not about the business risk, it is not about the net cash flow, but it is something about the effect attributable to the tax benefit. So, the only significant effect of that arrangement is attributing tax benefit. So, this is also a situation where it could be held as lacking commercial substance. And the third one, what they are saying is location of an asset or of a particular transaction is without any substantial commercial purpose or other than obtaining a tax benefit for a property. So, not only it does not have a significant effect, even the location in which taking place, the location in which that arrangement is decided upon, where it says the transaction will happen, either the whole arrangement or the part of the arrangement, you say that this transaction, this particular arrangement will take place in this particular location. For that particular location, there is no other value for that location other than tax benefit. The purpose of doing this transaction in a particular location, let us say you are doing it in a particular location called Cayman Islands. So, you are doing it in a location called Cayman Islands, which is actually a kind of tax haven for India. So, your intention of setting up a particular arrangement in that particular location, that is Cayman Island, is for no other reason other than obtaining a tax benefit. So, this will also be called as a lack of commercial substance. And they also say that they also give you some of the transaction types which could be called as lack of commercial substance. So, lacking of commercial substance, which will rule an arrangement to be not will get covered under GAAR. It is basically includes certain things. The first one is round trip financing. We'll see about this a little later in detail. We'll see about this in subsequent slide in detail. So as far as now this round tripping financing, we'll just understand it is, as the word says, what does it say? It's round trip, right? So let's say there is entity A, B, C. A gives it to B, B gives it to C, C may give it to D, and finally at some point in time it may come back to A. So there is some kind of transaction that is happening related to finance, where the intention of the transaction is only for obtaining a tax benefit. So here also what are they saying? There is no other substantial commercial purpose other than obtaining a tax benefit. So this is another thing which is actually being discussed as lacking commercial substance. The next one is we need to see that there will be an accommodating party. So this lack of commercial substance includes round trip financing, includes accommodating party. What is an accommodating party? We'll probably use the word adjusting. So you're just trying to adjust into the arrangement just for the sake of giving a tax benefit to the assessee. You don't have a role in that arrangement. In the earlier example, we are just speaking about A giving it to B, B giving it to C. Now B does not have a role at all, but to just fit into the arrangement to see that there are some tax benefits happening in that particular location or jurisdiction, right? So this is the intention of this arrangement and nothing else. So that party which is actually adjusting into the arrangement is what is called as an accommodating party. So the main intention of accommodating party is it provides either direct or indirect participation, and it makes sure its intention is to obtain a tax benefit for the assessee. If let's say A is the assessee, to obtain some tax benefit for A, it is structured in that way. So that's what it is there. Elements that have effect of settling or cancelling each other. So in a particular arrangement, you have certain clauses which will let's say it will probably negate the other thing. So one says this is what will happen, the other says by so and so reason the first clause is not at all valid. So one will overrule the other, in such a way that there is an elimination of that particular clause which will result in a tax benefit. So it has an element where it settles one another. So one clause settles the other clause, whereby it gives tax benefit to the particular person. Similarly, it is conducted through one or person in disguises the nature of such transactions. So there are transactions that's happening. I'll give you probably a small example of this particular category. Let's say you need to take away profits from India to a particular country. You could say that the holding entity is doing some management services. I am overseeing the US, let's say US is the holding company. US will say, I am overseeing the operations of India. I am helping them in point for 1, 2, 3, 4, 5, 6, 7 reasons. For all these reasons, I have been repeatedly helping them. So this support is what letting India earn money. So they will have to pay me so and so money. This may be the case, may not be the case. Now, if this is not the case, what is actually happening is India is shifting profits to US, which otherwise would have been given as dividend, which would have suffered taxation, right? So this is what you are calling it as disguise the nature of such transactions. The actual nature of transaction is what here? It is not management services, it is profit. It is distribution of profit, that is dividend. So in that case, it is actually taxable, but by categorizing as management services, India claims it as an expenditure and just transfers it across. So this is what you are calling it as the reasons which could be called as lacking commercial substance, So now we have understood overall some of the definitions. We discussed about what is lacking commercial substance, and we also discussed about various types of things that what GAAR contains, the definitions of GAAR, the key definitions, what is called as an arrangement. All this is what we discussed in this section 102, which talks about definition clause. Now, when does this GAAR arises? So when is this invoked? So when you say invoked, it is probably questioned. So when do you categorize something as covered under chapter 10A? When does it apply? So the situations in which this will apply. So this is discussed in section 95. Section 95 says when will GAAR will arise, when will the situation provide that this is a situation of GAAR. There is a general anti-avoidance here, so we must take action. When does this arise? So this happens in various scenarios. We will see that. Typically it is discussed in section 95. So what does section 95 says? GAAR will arise when an arrangement is declared, so what is important is there is an arrangement, such arrangement is declared as impermissible avoidance arrangement, So the intention of that arrangement itself is avoidance, so you cannot permit such an arrangement. So it is called as an impermissible avoidance arrangement. This arrangement is for the purpose of avoiding taxes, so this cannot be allowed. So it is an impermissible avoidance arrangement. So this is what will invoke the provisions of GAAR. Once you understand that an arrangement is an impermissible avoidance arrangement, you invoke GAAR. Right? When you say you, the tax authorities. So the tax authorities will invoke GAAR when they understand that a particular arrangement between two persons are called as impermissible avoidance arrangement. So now section 96. Section 96 says when can an arrangement become an impermissible avoidance arrangement. So basically there is an arrangement. In certain situations, certain conditions, this arrangement becomes impermissible avoidance arrangement. So what are those situations? So typically it is main purpose of the arrangement. So the main objective is only to obtain a tax benefit, so nothing else. We said, right, there is no other substantial effect, there is no other significant impact to other transactions. So when that is the case, when the only situation is about tax benefit, that will be called as an impermissible avoidance arrangement. Apart from that, they have given some conditions. So what? It must satisfy at least one of the following conditions. So even if one condition is satisfied, it will be called as an impermissible avoidance agreement, right? So now what is that? The first one says it either create rights or it creates obligation which are not ordinarily created, between persons dealing at arm's length, which means when you say dealing at arm's length, so typically when there are two strange transactions, two third party transactions, there would have been certain set of conditions, there would have been set of certain terms, right? All this, if it varies and creates certain rights or obligation which would have generally not happened in certain circumstances. So that is what is called as this, will be called as an impermissible avoidance agreement. So there are the arrangement as clauses which creates rights or obligation which a common person, that is two stranger persons, two third party persons entering into, will never have that clause. I'll just put a lame example, just don't take this example seriously. If a clause contains in a rental agreement, if a clause contains, it is okay if you don't pay me the rent. If there is a clause in a rental agreement which says it's okay if you don't pay the rental, is it okay? Will any strange persons, will any third party person come out and say it is okay if you don't pay me the rent? There is no such possibility, right? So the only possibility that we are talking about is they both are related, they both are closely connected. So that is where this influence has resulted in a situation where they are able to enter into such agreement where they say it is okay if you are actually not giving me. So that will be called as an impermissible avoidance agreement. So what is the next condition? Directly or indirectly results in misuse or abuse of the provisions of the act. Yes, you are following the law, but you are not following the law with its intentions. You are not following in accordance with the intentions of the law. So the intention is not followed. Intention of law is not followed. So there is misuse of provision or abuse of provision. Let's say 80D, okay, 80D is medical insurance premium eligible for the family and the parents. Let's say I myself am claiming that 80D, I am also saying my spouse, you also claim the same 80D. Now 80D says you can claim it for family, right, family. So just because it says you can claim it for family, I cannot claim it in both the person's respective income, right? So I cannot do that. So which means I am actually misusing or abusing the provision. So this will result in such result in tax evasion. and there could be lacking commercial substance, and then also it will be called as an impermissible avoidance arrangement. We already discussed what exactly commercial substance refers to. Now, entered into which not ordinarily employed for bona fide business person. It is similar to what we discussed earlier. Two strange persons will not have such business arrangement. So, general good business arrangement will not have such clauses, will not have such discussion. So, that is what they are saying to say. It is entered which are not ordinarily employed for bona fide business purposes. So, that is another category. So, now all these includes called as impermissible avoidance arrangement. So, this is what you are calling as impermissible avoidance arrangement. So, these are the categories in which if it exists, if these conditions are satisfied, at least one, if at least one of the condition is satisfied, this arrangement could be called as an impermissible avoidance arrangement. It is also further to be noted that the main purpose, that is the objective of that arrangement, is only to obtain a tax benefit. Then it shall be presumed that the main purpose of entering into arrangement for a tax benefit. So, if the intention of that arrangement itself is to have a tax benefit, then by default it will be assumed that such arrangement is a impermissible avoidance arrangement, IAEA, right. So, this is what is called as, this is what are the situations in which an arrangement will be called as an impermissible avoidance arrangement. Once an arrangement is called as an impermissible avoidance arrangement, the provisions of section 95 arises. So, GAAR is automatically invoked on such arrangements. So, that is what you are calling. But as we have always been discussing, there will always be exceptions to the existing rule. So, similarly, Rule 10U of Income Tax Rules 1962 provides certain situations where, though it may fall under one of the conditions specified or whatever it is, it will still not be called as GAAR. It will still not be called as GAAR. So, what is that? Where the tax benefit, there is a tax benefit in the relevant year arising to all the parties to arrangement does not exceed what? So, they are bringing in the concept of materiality. So, they are trying to say, I am leaving out the small businesses. So, whenever the tax benefit does not exceed 3 crores, even though it lacks commercial substance, it will not be called as, probably I should not say it is not called as impermissible avoidance arrangement. Though it may be an impermissible avoidance arrangement, GAAR cannot be invoked. GAAR cannot be invoked for transactions which has a tax benefit less than or equal to 3 crores. That is the first thing. The second category is a foreign institutional investor. So, foreign institutional investor is basically an assessee who has not availed tax treaty benefit. So, he has not availed the DTA benefit, he is only applying through Income Tax Act, was invested in such prior permission of competent authority. Now, this particular foreign institution investor has got the permission of the concerned competent authority, only then he is investing, and plus he has not availed the benefit of tax treaty, that is DTA. So, in that case also it is not applicable. Similarly, a non-resident in relation to investment in offshore derivative or foreign institutional investor. So, it also includes a non-resident. So, it will not be applicable for these non-residents. Which non-resident? Which is the non-resident who has invested in offshore derivative instrument or in a foreign institutional investor. So, those persons, those transactions, GAAR will not applicable to them. Similarly, anything which is before 31st March 17. What is the reason of this thing? Basically, it is to see that the provision introduced, it is not retrospective. So, whatever was introduced, whatever has happened till 31st March 17 will be ignored for the purpose of considering this GAAR. So, that is what is there. But what we have to understand is, generally in section 90 we said DTA benefits, income tax benefit, whichever is beneficial, right? Assessee can choose whichever is beneficial to him, but chapter 10A says the GAAR provision overrides all other tax treaties. So, which means this is not applicable in chapter 10A. In chapter 10A, the concept of whichever is beneficial is not applicable because GAAR provision shall override all the tax treaties. So, that is what it is about. Now, we have been talking about that there could be lack of commercial, that is, it shall be deemed, it shall, if there is lack of commercial substance, then it may probably called as an impermissible avoidance. There are certain situations where the arrangement will be called as deemed to lack commercial substance. So, maybe the arrangement actually has commercial substance, but still it shall be deemed to be lacking commercial substance. So, basically the first situation is the substance or effect of the arrangement as a whole is inconsistent, whatever we saw earlier, right, differs significantly. We saw that if there are 10 clauses, 8 is favorable, 2 is unfavorable, the 2 results in undue benefit. So, that is what we are saying that it means. Similarly, we said it will involve round trip financing, accommodating party eliminates or whatever. Now, we also saw that location is irrelevant, that is just for the benefit. If you transact in this location, you will have a tax benefit. If you transact through such source, you have a tax benefit. So, whatever is happening is, if it is the benefit through a location or a source or ownership, is also called as lacking commercial substance. So, there we said only through location, but here we are trying to understand not just location. If there is a disguise, that is either the nature of transaction or giving a benefit through the location or through the source, whatever is happening could be called as lacking commercial substantion. So, that is the what we are calling it as. So, the simple point here is anything where we say that it does not have any other effect, that arrangement does not have any other effect but for tax benefit. So, that is the only reason. If that could be proved, then it could be said that it lacks commercial substance. Otherwise, everything is what we have already seen in this particular session itself. So, this will be called as lack of commercial substance. Now, we will just understand few terms such as round trip financing, accommodating party. We did see, right, it includes an arrangement, includes which says that lacks commercial substance, includes certain transactions such as your round trip financing and accommodating party, or where it eliminates by offsetting. One provision offsets the other provision, that is also a possibility, right. So, we will see, understand the certain meaning of certain terms alone, that is your round trip financing and accommodating party. What exactly is round trip financing? Probably when I just said ABC, A gives to B, B gives to C, let us say C gives to D and D gives to A. This is something like round trip financing. Now, what exactly could it be called? What exactly it could be defined? So, the first thing that we are talking about is includes any arrangement in which through a series of transactions, funds are transferred among the parties to the arrangement, right. So, which means in this case the parties to the arrangement, let us say A and B, right. So, A is transferring to B. Now, such transaction do not have any commercial purpose other than obtaining tax benefit for particular person. It could be to A or to C. Now, A or C is going to obtain tax benefit because of A transferring some finance to B. The arrangement where B will help money flow to C, and let us say A and C are benefited through this transaction. So, now this transaction could be called as round trip financing, and we are talking about this, that is when I am saying that funds are transferred among the parties to the arrangement, we could say that certain things is irrelevant, What are those certain things? Whether or not the funds involved, in the round trip financing can be traced. So, can be traced to any fund transferred to or received any connection with that arrangement. So, now I know that A only gave to B, I know B only gave to C. So, can I say there is no intention, because it is transparent. A has transferred to B, B has transferred to C. It is a very transparent transaction. Can I say it is not round trip financing? But that is not the case. That is what they say, whether or not the funds involved in the round trip financing can be traced to any fund. So, you know that A only gave it to B, but still it is called as round trip financing if there is a undue tax benefit given to one of that entity. Similarly, it also doesn't matter the time, the sequence, like let us say A to B, B to C, C again to A, or C to D, D to B and B to A, whatever order, whatever timing it is, whatever sequence it is, if the funds involved in the round trip financing are transferred or received. So, it does not matter, certain things does not matter, like your time and sequence in which the way the funds are transferred. Similarly, the means by or manner in or the mode through which funds involved are transferred. So, it does not matter whether it was given through bank, given as loan, whatever name you call it, whatever mode you call it, it could still be called as round trip financing. So, this is basically round trip financing. So, what is round trip financing? In short, if you wanted to understand, it is basically funds are transferred among parties to the arrangement. Such funds has no other purpose, there is no commercial substance other than the tax benefit. So, the only reason why fund is transferred from one entity to another entity as a part of arrangement is because tax benefit, there is nothing else. So, it does not matter whether the fund can be traced, it does not matter whether the timing, sequence, nothing else matters. And similarly, the last one is, it does not matter the manner, mode in which that finance is transferred. So, that is what you mean by round trip financing. So, what exactly is accommodating party? When you say accommodating party, we said some party comes into the arrangement just to support someone. So, that is what you are meaning by. So, the main purpose of the participation, is to obtain, a tax benefit either for the assessee, right. So, benefit for the assessee, whether or not the party is a connected person and related to any party to the arrangement. So, what are they trying to say is, the main purpose of this accommodating parties, the reason why this party is part of it. In our case, when we said A to B and B to C, the reason why B is there is nothing else other than giving tax benefit, let us say to A. So, it has to give tax benefit to A. If A directly gives it to C, there may not be any tax benefit. So, just routing it through B, there may be some tax benefit that accrues to A. For such reason only B comes into the picture. So, that is what they are saying. The main purpose for the participation of B here, is nothing but to obtain a tax benefit for the assessee, that is A in our example. So, that is called as an accommodating party. Now, once you call something as, you wanted to call something as impermissible avoidance arrangement, certain factors are not sufficient. Yes, it may mean that it is an impermissible avoidance arrangement, but that alone is not sufficient. Probably you need more reasons or something. So, basically, which is about the period or time for which the arrangement exists. So, the timing in which that arrangement has been entered into, it is okay. Let us say they say that we have already paid all the taxes what is due for us. So, where is this called as an impermissible avoidance? So, it does not matter. So, the timing does not matter, the facts of payment, whether taxes are paid or not, does not matter. So, all these things. Similarly, fact that an exit route is provided by the arrangement. So, which means because of that particular transactions, whether one person is probably able to exit smoothly, that is without any issue, is one party able to move out of the particular arrangement. So, is that happening? So, all these are irrelevant, that is what they are saying. So, all these are irrelevant, and that alone could not be, but factors that are relevant but not sufficient. So, these factors which we are discussing are relevant to rule something as impermissible avoidance arrangement or rule something as lacking commercial substance, but this alone is not sufficient. Just that the timing was not, does not sound good, or just that the taxes have already been paid, where is the question of tax evasion, or there is always a proper exit that has been made from that arrangement. So, what is the need for this tax evasion or something? So, this is alone not sufficient. You need additional proof to say that the intention of such exit, the intention of such transaction evasion or whatever it is. So, finally, now once you know what is GAAR, whether GAAR is implemented or not, what will be the consequences once someone knows that there is a agreement which will be called as an impermissible avoidance. So, the first thing is denial, right. So, of course, the intention of his tax benefit. So, this tax benefit is completely denied. So under the provisions or the treaty. So it could be either under the act or the treaty also. So the denial of tax benefit could either be under the act or the treaty itself. But there are few more things, that it is not only restricted to these, it also includes what else can happen. It is not only denial of tax benefit, what else can happen through invoking GAAR, what else can happen. The first thing is, they could either recharacterize or combine or disregard. If we say two clauses are contrary, they could either say this two clauses is not at all applicable, or recharacterize these two clauses, or probably combine with the other 8 clauses to see that it becomes a proper arrangement. So that's what is there. So for any impermissible avoidance arrangement, if there is some issue, the issue could be disregarded, the issue could be combined with the other clause, or it could be recharacterized. So these are all possibilities, right, to see that you are not unnecessarily troubled. Treating as if the impermissible avoidance arrangement has not been entered into. So now, as if the arrangement itself is not entered into, what would have been the tax position? If that arrangement was not entered, what would have been the tax position? That will continue to apply. Similarly, disregarding an accommodating party or treating accommodating party or any other party. So if A, B, C as the transaction, I am again repeating this concept of A, B and C. Now what if you think that B is not at all there, the only transaction is between A and C. So you assume that the actual transaction is only between A and C, B is only as an accommodating party. So I am not going to consider, I am disregarding the accommodating party or treating the accommodating party along with A. I am considering both A and B as one single entity. So that's the consequences. And the last consequences is deeming persons who are connected persons in relate to each other to be one and the same person. So when there are connected person, you assume those connected persons as one single person to see that that the transactions, whatever impact you are giving, whatever consequences is supposed to be faced, it could be held that such connected persons could be treated as one, so that the impact will be accordingly computed. So those are the consequences. What are the other consequences? You could either, initially we said that they could recharacterize the arrangement or whatever. Now we are saying they could either reallocate or accrual or receipt of any expenditure. So whatever is the tax benefit, it is not only the arrangement is recharacterized or modified or whatever, they could also reallocate any accrual or receipt or any expenditure deduction relief. So they could make changes to anything in such a manner to make an impermissible avoidance arrangement as a proper arrangement, and whatever was supposed to be evaded, you could stop them in evading all that. So that's what is there. And then you have treating the place of residence. This is actually place. Treating the place of residence or the situs of the asset or at a place other than the place of asset or location of the asset as provided in the arrangement. So we said location is irrelevant. If that location is trying to be misused, you could accordingly act. You could accordingly, the department could say, I will ignore this place, or I will only consider this as the place of residence. So all that can be added. So where a part of an arrangement is declared to be an impermissible avoidance arrangement, so if only a part is called as an impermissible avoidance arrangement, in that case, the consequences in relation to tax shall be determined with reference to such part only. For example, if the impact out of 10 clauses, what impact is only 2, the tax benefit, that is whatever consequences, will be only for this 2, not for the entire 10 clauses. So this is another important thing. So where a part of an arrangement is declared to be impermissible avoidance arrangement, the consequence should be only for that part, not for the whole factor. So now for the purpose determining whether tax benefit exists, so that's what we said, right? Everyone has to be considered as one person. You may disregard accommodating party, you may you may treat all connected person as one or whatever. So the parties who are connected persons in relation to each other may be treated as one person. Any accommodating party may be disregarded. Again, they may be treated as one. We already discussed this, so I am not going into this. So again, this is important thing. An arrangement may be considered or looked through by disregarding any corporate structure. What do you call? You call this as lifting corporate veil. Corporate veil. You also call this as substance over form. So this is what is referred as. So in a particular arrangement, if required, you look through the corporate structure, you may lift the corporate veil, or you might see that you may see substance over the form of the organization. So these are the treatments. So the procedure is, once the assessing officer, if he feels that a particular arrangement is impermissible avoidance arrangement, the assessing officer will make a reference. There is a form for this, form 3C 3CEG. He will make a reference to the principal commissioner or commissioner to invoke GAAR. Once the particular authority receives it, the authority may issue a notice saying that why this arrangement should not be called as impermissible avoidance arrangement, asking them to show cause reasons. Now, after providing sufficient opportunity, within 60 days, he may pass. So he may pass an order, he may issue a notice and conclude the matter within 60 days. So that's what is there, not exceeding 60 days as specified in the notice. So once a notice is specified, an assessee may be given an opportunity within 60 days from the date of the notice. So after receipt of notice, probably they will see and then decide what action to take. So what action can be taken? If the assessee says, okay, I don't object, I also know that it is impermissible avoidance only, so he will issue such directions to treat it as an impermissible avoidance arrangement. So the authority, that is principal commissioner or commissioner, will issue directions. What if assessee objects? He will pass the directions in form 3CH to the assessing officer with a copy to the assessee, saying that, see, I feel yes, it is an impermissible avoidance arrangement, but the assessee is objecting. So this is what will be considered here. And the one is, in this case, if assessee is objecting, authority says, no, it is still impermissible only. In this case, the assessees both are okay. AO is also okay with the decision of assessee. So we say it is not an impermissible avoidance agreement. So 3CEH, the assessing officer will give it to the assessee, saying that, okay, I agree, this is not a particular impermissible avoidance arrangement. But in the last case, what if assessee says it is not impermissible avoidance arrangement, but authority says, no, it is only impermissible avoidance arrangement, I am not okay with your arguments. If the authority is disputing, of course the order will be sent to the approving panel. So there is a panel for this who will probably discuss this. The syllabus does not contain all this about what the approving panel does and all those things. So we will stop it here to understand what exactly this tax avoidance planning and evasion is also about. This is what GAAR is about. So once GAAR is invoked, what all can be done. So this is what we have understood from this particular session. So with this, we wind up this session. Thank you for the wonderful session.